Cathie Wood gets a dedicated video here today. It's all her, okay? Cathie Wood's going to speak about the economy, about tech, about Elon Musk, about Twitter, about Bitcoin, about Fed policy. I'm sure she's going to talk about her stocks. I haven't actually watched this video yet, so it's going to be my first time seeing it as well. It's just came out 7 hours ago, so I'm looking forward to reacting to this and hearing what she has to say and kind of giving my opinion based on that. And in terms of Cathie Wood, she's in a little trouble again, unfortunately, because Roku, which is her third biggest position, is down after hours 16%. So it's been obviously a very tough go at it for Cathie. And if you're not up to date on the whole Cathie Wood story, you know, this 5-year chart basically explains it as good as it can possibly explain it. Cathie Wood is the yellow line there. This is our main ARK fund, okay? And so obviously it had unbelievable performance in 2020, 2021 for the most part, up until the very end, essentially. It was massively outperforming that blue line there, which is the NASDAQ, which is usually you're going to think about performing very well, right? And this is the S&P 500, the orange line, okay? And so she was massively outperforming indexes, and this is why so much hype built around Cathie Wood. It wasn't for no reason. It wasn't like, you know, people just thought, oh, Cathie Wood, let's just start talking about her and make her a big deal. No, it's because she was killing the market for almost 2 years there, right? But here's the big issue. She always wants to be obviously judged on a 5-year time frame, but unfortunately, right now she's up 3% in the past 5 years on the ARK fund, while the S&P 500 is up 45% over the past 5 years, and then NASDAQ's up 73% over the past 5 years. So obviously, that's a real problem for her, but you know that this explains it best on why she got so much hype and why she has gotten so much hate over the past year, to be quite honest. So looking forward to enjoying this one with you guys. By the way, 18,200 plus subscribers now at this point in time. Absolutely insane. YouTube wants me to change up my thumbnails. Look at this, okay? So this is what it showed me. It said stand out next to other thumbnails, and these gives me auto-generated thumbnails from obviously other YouTubers and whatnot, and it wants me to go to like this style of format. But I just enjoy it, man. I just take a picture of myself, I post it up. It's like, man, I don't know, man. I just don't care that much in terms of like all the YouTube stuff that you have to do and whatnot. I'm just like, take a picture of myself, throw it up, man. It is what it is. Like, yeah, could I maybe get more views, I guess, if I put explosions and fire and all this stuff? But it's just, I don't know, man. It's just, I feel like picture, boom, throw it up. I don't know. That's just me, man. It is what it is. So I appreciate all you guys that, you know, even with the thumbnails just being a picture of me, you still click on the video without having to put a big and stuff like that, all that good stuff. So appreciate all you guys. Much love as always. And thank you everybody that subscribe to the channel. Let's get into this.
Minded of this, but for viewers, obviously, and context is important. So that 120% upside that you saw for the central fund within ARK, of course, between 2020 and 2021, and now, of course, year to date, the flagship fund down about 60%. What are the lessons learned then from you and the team from that kind of drop that we've seen?
Yeah. So it started actually in February of 21. We started declining. Truly disruptive innovation started declining in February of 21, while the market soared to all-time highs in 21, and now the rest of the market is suffering as well. So vaccine, people going back to work, supply shock. The businesses had shut down, wondering if they would ever reopen their doors, right? They shut down. At the same time, governments around the world were stimulating aggressively. So we had a supply shock, especially because demand actually was so much stronger than anyone expected. And I would say lessons learned. Could I have dreamed, a technology investor, that supply chain issues would have lasted more than 2 years? No, I never thought that for a second. I thought we would be over that in a year, and certainly couldn't have predicted Russia's invasion of Ukraine. So the question is this a 70s style inflation, which is how the markets are treating it right now, and why our strategy has been decimated, and most growth strategies have been hurt very hard. We don't think it is. I think the market's pricing is pricing innovation as though we have a bad inflation problem that's going to take interest rates up even higher. We don't think so. We think actually the greater risk and opportunity is deflation. I think we're going to start seeing deflation on a month-to-month basis. We're already seeing commodity prices come down. They've broken down, many of them. That's upstream, at the top of the pipeline. At the bottom of the pipeline, around the world, we're seeing a massive inventory overhang as we're heading into the holiday season. How will they clear that? Discounts. So I think cyclically, we're going to see deflation. We're already seeing it in the pipeline. Secularly, we will also see deflation. We spend all of our research time focused on disruptive innovation.
By the way, Cathie's been talking about deflation. I watch almost every one of her big interviews she does, like these. Sometimes I obviously react to them on the channel, and she's been talking about deflation for a while. I would say probably almost a year now. It's certainly at least 6 to 9 months, but it's probably getting close to a year she's been talking about deflation. Obviously, we haven't seen it yet. It doesn't mean it's not coming. It's just we obviously inflation's been, I think, much higher and much stickier than I think, honestly, even bears predicted. It's been unbelievable.
Technologically enabled disruptive innovation that is inherently deflationary, but that's good deflation, because as prices for electric vehicles continue to come down, we will see a continued boom in electric vehicles. It will hurt the internal combustion engine cars, but it will.
I'll be honest, she's way off subject right now. Oh, she's so far off subject. Jeez.
The innovators. So I think we're going into a deflationary period, much like the late 19 teens. So 1918, World War I ended. Spanish flu also hit. So think about that. War, flu, very similar dynamic, right? And the other similar dynamic was 3 major innovation platforms that were going to transform the world: telephone, electricity, and automobile. They were all scaling exponentially. And took us into...
She got way off subject, man. Holy smokes. And this guy is trying not to be rude and pull her back in, but man, she's so far. Remember, this question started with, what did you learn from, obviously, the ARK Fund doing so amazing and now doing so bad? And she's now talking about 1918 and what happened back then. And Jesus.
Roaring 20s. So supply shocks took inflation back then to 15%. But within a year and a half, 2 years, that inflation started dropping, and it ended down. The inflation was 20%. It ended down, deflation, 15%, roaring 20s. I'd like to think that's what we're going into now. And there's a high probability we are.
Okay, so that's the deflation call. So are you also making the call that growth has bottomed now, that this is the opportunity to get greater exposure to growth, that we are seeing the bottom now in terms of the sell-off for tech?
So it's interesting to watch our strategy as fears about Fed tightening and more Fed tightening continue. On many days when the market's down, our strategies are up. Now, that is what tends to happen. I'm not promising this is where we are. My compliance department would never let that happen. But in the later stages of a bear market, our strategy starts to outperform. Even it may just be that we're down less than the market. Some days we're up when the market's down. Why? Because during the later stages of a bear market, the new leadership shows up and starts performing. We're the new leadership. We always are. And many people...
So to fact check that a little bit here, obviously she's not really directly answering this question, but that's fine. She has, the ARK Fund has underperformed for the past 1 month as well. So, we haven't seen what she, I think, thinks is going on. We haven't really seen that yet. I'm sure there might be a point in time when the ARK Fund starts to outperform the S&P 500, and maybe like Dow 30 stocks are starting to fall, and some of her stocks are starting to go up and things like that. I definitely think that's a possibility here, folks. But we haven't seen that yet, okay? Like literally, you take it back. Let's even see on the last 5 days if that's happened. No, in the last 5 days, ARK's underperformed. So let's see the last 1 day. So last 1 day, ARK has underperformed both those indexes. Last 5 days, it's underperformed. Last 1 month, it's underperformed. Last 3 months, it's underperformed. Last 6 months, it's obviously massively underperformed. And then year to date, it's a whole different story. And 1 year is a whole different story there. So, so whatever she thinks might be going on there, it's not going on yet. It doesn't mean it can't start going on in 2023, but it's not going on as of right now.
oh, I've got myself covered with the NASDAQ 100. No, look deeply into those indices. We are the new NASDAQ, and most of our stocks are not in those indexes. We haven't owned the FANGs in our flagship for quite some time. That's not the new anymore. TikTok has come along and destroyed a lot of models. So yes, I think that we're seeing the early stages of a bottoming process. At the same time, many people are saying we're going into a recession. Now, we think we've been in a recession, and that the negative numbers will reassert themselves after this positive third quarter. Mostly because of the inventory overhang, and we need to clear that.
First off, this is very important. I agree with her that we have been in a recession. I agree. I think the numbers show. I think, I've gone through this many times in videos in the past, like everything lines up there, right? But with that being said, just because we feel like we've been in recession, right, it doesn't mean the recession can't get worse, right? You can't hit a lot of other things, including job losses, construction drying up, things like that. Those are my worries for 2023 as 2023 rolls along, with obviously the cost of capital being extremely expensive, and the debt market being in the situation it is, and maybe even potentially in a worse situation if the Fed keeps raising rates. I mean, that definitely scares me a lot in terms of the construction field for new homes being built, for new offices being built, for new restaurants being built. All this massive construction we've had, right? New apartment buildings and new condos and all that stuff. I'm definitely very worried that that's going to dry up as 2023 goes along, and maybe even get worse into 2024, to be honest. So that's my concern. The longer rates stay high, the longer rates stay at a very elevated level, the more likely we're going to have, pretty big economic carnage on the other side of this situation. So do keep in mind, it can, just because we might feel like we've been in recession doesn't mean it can't get worse.
I think many forecasters may say, oh, this is going to last forever, this recession through. We think it's just a major inventory correction, and then we'll be on our way again.
So a short-lived recession is what you're forecasting?
Sure. Well, we believe it started at the beginning of this year. So if it ends in the middle of next year or the third quarter, it's not so short-lived. It's only short-lived given that that many people in a midterm election year don't agree that we're in recession now.
So the skeptics would say that what we saw in 2020 and the early stages of 2021 was valuations, of course, being pumped up by that excess liquidity that was in the system as a result of years of central bank interest rates at near negative levels and, of course, quantitative easing. And that it was never about the fundamentals. But you would obviously push back on that.
Yes. Well, if that were true, then we should have been soaring for the entire existence of our firm. We started our funds in 2014. The number of risk-off, risk-on periods we went through during that period up to COVID was quite astonishing. That low interest rate, negative interest rate did not do what most people think. It just didn't. They're ascribing the massive increase that our strategy saw in 2020 to low interest negative. No, we're going to say no. Innovation solves problems. COVID-19 created massive problems. We needed to sequence the virus to understand how it worked. We needed to develop tests. We needed a vaccine. So no wonder that our genomic revolution strategy was the best performing strategy during that period. Innovation solves problems. We needed to digitalize everything we do.
It doesn't necessarily mean that. It can also mean hype and excitement around it, right? No different than we see this in all types of industries. We saw it obviously in the EV industry a year or two ago, right? A lot of hype there, and it was like, how many vehicles are actually produced? It's just excitement there, right? And so when you have a once in 100-year health event going on, money's going to pump into all those things just because that's where the hype is. Doesn't mean that's where things are being solved, or all her companies like solved magical things or something like that. It just means that that's where the money's being pumped at that particular time because there's massive hype there. And so I just think that's really important just to kind of keep in mind there. So, I'll be honest, I'm getting a little frustrated with this interview so far.
Work.
I'm going to try to keep my cool though.
Play, healthcare, education, and that innovation helped. Now, what has happened since then, because many people think that that burst, and from the low in COVID, April of 20 to February of 21, our flagship strategy was at 360%. Now, innovation solves problems, but by the end of all of that, we were saying, okay, keep some powder dry, because our minimum hurdle rate of return for any stock to get into the portfolio is a 15% at a compound annual rate for the next 5 years. We hit that in February of 21. Now with the massive downdraft we've seen, our rate of return expectations have never been higher. I've never seen them higher in my career. Cannot tell you what they are because compliance, of course, has a lot to say about that. But as you said, being down 75% plus from that February peak, when innovation...
I don't understand why she can't say it now. Like if she was saying we expect to get this sort of return on our stock, she's said this a million times in the past. Oh, we expect our fund to get this much. Oh, we expect this stock to, these stocks to get this much. So now all of a sudden she can't say it. I don't know if that's really the truth there, or maybe she's been so heavily damaged. Obviously, she doesn't even want to say an expected return, or maybe she's afraid of sounding crazy because if she says, we think these stocks are going to 7x or 10x over the next 5 years, something like that. Maybe people will look at her crazy and she just doesn't want to. I don't know, man. That's just weird because she's gone out there many times and said it, and now all of a sudden she's not going to say it. Like, come on.
Still solving problems, and we have so many more problems than even during COVID. We have the war, we had all the supply chain problems, and we have a recession, which is going to force most companies to say, how do I increase productivity? How do I cut costs? Technology is usually the answer. So I think we're coming into a moment, hopefully many moments, where innovation is solving problems and our revenue growth rates are going to surpass by far the revenue growth rates that the overall economy will deliver.
Would the Fed...
You hear what she just said there? Revenue growth rates. She said revenue growth rates. And that's the issue in the disconnect we have in the market right now is the market doesn't care about revenue growth rate. Market cares about, if anything, balance sheets and profitability. That's what the market cares about. Revenue growth rates a year and a half ago, 2 years ago, oh man, that was all the hype. That was all the hype. Like, it's all about revenue growth rate, but the market simply doesn't care about that anymore. And so that's why there's this big disconnect of, like, she's talking about our revenue growth. At the end of the day, you really need to be talking about what's net income growth. So that's what investors are actually caring about. That's what Wall Street actually cares about. That's where most money actually cares about now at this point in time. And if you look at the stocks that have held up decent, honestly, at the end of the day, it's the ones that have the net income that keeps pouring in, the cash flow that keeps pouring in. And we're trading at, roughly fair valuations and things like that going into this whole situation. So that's where the disconnect is there. And, even myself, as I'm a growth investor, right? And I invest in a ton of different growth stocks. I'm thinking about where these companies' net incomes are going over the next few years, where their margins are going over the next few years, and where their cash flows are going over the next few years. Because I understand, it's a very different market now, and you can't just count on revenue growth now. It's going to be about profitabilities and margins moving forward until we get into some major hype cycle again. And who knows when the next major hype cycle is? It could be 2 years from now. It could be 4 years from now. It could be 8 years from now. You never really know. It could be a while. So, I think in any market you should care about things like obviously profitability and net income and what company's net income is going to over time. But I think in this market, obviously, you definitely have to care about what's going to happen with the company's net income. I think she should replace the word revenue growth with, what about net income growth? Is the net income growth of these companies going to exceed whatever the market's growing at on average for net income?
An end of front loading of hikes prove a catalyst, do you think?
Every one of my stocks, I want to see them increase net income rapidly in 2023, regardless of the economy, and especially all my small caps. A lot of those money-losing companies, they need to flip as fast as possible to positive cash flows and get their margins in a much, much better place. I need to see that over the next year.
Very interesting. I think you may know that we wrote an open letter to the Fed saying, wait a minute, how can the 12 of you unanimously agree on 75 basis points at, one right after the other when commodity prices are falling, inventory overhangs are crushing companies, and so you have upstream deflation. We believe downstream there will be deflation. There's no debate over this? Are you kidding? Do you know that in the early 80s, and I was fairly new to the business, Chairman Volcker...
It's getting too steamy, man. It's getting too steamy in here.
was fighting a
Maybe I'm getting a little frustrated. It's getting too steamy for me.
15-year inflation problem. It started in 1964 with the Vietnam War and the Great Society. So 15 years, and people were used to inflation, so they were demanding it in wages and so forth. He took interest rates up twofold, 10% to 20%. This Fed has taken interest rates up roughly 16-fold in 9 months. Now, economics takes place at the margin, changes at the margin in all kinds of pricing, and interest rates are prices. Changes at the margin are incredibly impactful. And I think we will look back in history and say, wait a minute, a 16-fold increase in 9 months without stopping to see what's happening is crazy. It's great.
Yeah. Okay. Yeah. But fair. But also on the other side, Cathie Wood, in all due respect, between government programs, between what the Fed did, I mean, we're talking about trillions of dollars poured out there, and it wasn't just the Fed; it was other, central banks around the world. So do keep that in mind. That could be, that could be pretty crazy as well. I mean, to be honest, Rona messed up everything. I think we'd be in a much healthier place as an economy, as everything, as a stock market, as a real estate market. If it wasn't for Rona, I think everything would be a lot healthier than it is right now. Instead, we got a market that probably pushed up way too much. We got growth rates that pushed up way too much. Now we're taking everything away from everything, right? And that's already causing a lot of problems, and it's going to cause more problems. So neither side's been healthy, to be honest. The trillions that we just flooded out there, and then now the sucking up of all that none of that's healthy.
And this is what will take inflation from up 8 to 10%, where we think it peaked, to negative.
You talked about cost cutting and companies trimming. We've seen from the likes of Meta, hiring freezes there, other big names, Amazon and others, putting in place hiring freezes or indeed cutting jobs completely. How much bloodletting do you expect to see across the tech sector? How much more pain in terms of job cuts and in terms of reining in budgets?
Well, if you look at trendline employment gains, I think we're 9% above the trend that was in place pre-COVID. In other words, a lot of companies, and tech companies included, hired many more people than they should have, given what was going to ultimately happen to demand. And the first place you see a recession is in advertising, and the advertising budgets have been slashed. That's why, to me, hearing people say we're not in a recession and seeing advertising budgets cut in half by some companies is quite astonishing. And it's hitting the tech sector because so much of tech has become social media. But other technologies, I think, that help drive efficiencies. So more enterprise SaaS, they're probably going to do a lot better. We receive a lot of criticism for holding Zoom. Many people say, that's a COVID stock. Well, Zoom basically gave its service away for free to consumers and to education, which was the right thing to do for a crisis period. Now they're all cycling out, and enterprises are cycling in. Enterprises, I believe, 55% of their revenues, and they're adding new features and functionality. This is the first rip and replace cycle in the enterprise communications space, which is the largest part of the tech stack. So it's $1.5 trillion a year. First rip and replace cycle since the early 90s. The early 90s, Cisco helped build the backbone of the internet. All of that was on-prem, hardware-centric. Now all of that is going into the cloud, and it was stimulated by COVID. These enterprises finally said, okay, we have a reason to make the change now. Two winners, Microsoft and Zoom.
What do you see in Robinhood? This is the mobile trading.
Okay, so in terms of Zoom, something important there is their earnings are expected to go down, right? At least for the next year. or two. And the stock's still trading at a 20-something forward PE. So, usually if you see a company with their earnings going down, like usually it's not trading at a 20-something PE. And with Zoom, obviously, there's a lot of questions there about how much pricing power does Zoom really have, especially if Microsoft is throwing in a competitor in their suite of products for, basically free, right? And obviously with even potentially Apple wanting to play there more over time. I'm sure you guys have seen now you can do FaceTime with links and things like that. I'm sure Apple wants to get much more in that space. Apple loves communication. They have obviously iMessage. They have FaceTime. I mean, who's to say Apple's not going to just have the service for free? Apple's like, dude, all we care about is selling the next $1,000 iPhone and the next $2,000 MacBook, right? So for them to throw an exact copy that probably works even easier and better than Zoom at no additional cost, just you get it since you own the device, I just think that's a matter of time in regards to that, right? So, I think that's just something important. And we haven't seen Zoom really innovate in a major way outside of that, to be honest.
Platform, you've been buying Robinhood in recent weeks. That is a company that's cutting jobs. That is a company that's retrenching. Yeah. Some of their incumbent competitors, Charles Schwab amongst them, are doing very well. What do you see, though, in Robinhood?
Yeah, yes. I would love to hear what she has to say about Robinhood, a company that's lost, I don't know, what is it, 10 million monthly active users, some insane number, okay? And, you go through her stocks here. We just spoke about Zoom, right? Tesla, obviously great company, but, obviously it's going to be a tough next year in terms of trying to hit those growth rates with a tough credit environment, right? Never mind if unemployment goes up and those sorts of things. Roku, we just talked about that one, down 16% after hours. Some of those I don't want to speak on. Block's obviously been hammered. They report earnings in actually within the next 24 hours. That should be interesting. Teladoc came off that hype cycle and, obviously it's kind of died down. Shopify, she needs to make this a much, much bigger position, in my opinion. That should be a top 5 position easy. I think it should be our number 1 position, my personal opinion. Coinbase, crypto's going to come back someday, but, is crypto coming back anytime soon? Probably not, to be honest. Roblox, I don't really want to speak about that one. Robinhood's their 16th biggest position, and DraftKings is something that, a lot of folks that use DraftKings are kind of in that middle class and maybe even under. And if those folks are in a tougher environment, that's gonna hurt DraftKings. And they spend ridiculous amounts of money. Every time I turn on Fubo TV and watch some football games, man, the amount of DraftKings commercials I see with Kevin Hart in them, like, you know how much you got to pay Kevin Hart to do those commercials, and then you're paying for all these advertising spots. Ooh boy.
So
you got to win a lot of $20 bets to make that baby pay off. That's all I'll say about that.
Robinhood, along with Coinbase and Block, the three of them we think are in the running for dominating, potentially, the digital wallet space or becoming an important component of it. Robinhood is very user-friendly, and it is now moving into the crypto age, which is what it was missing. We've watched that very carefully. There is a company in Israel called Fireblocks, and we were very happy to learn that Robinhood basically ended its strategy of building internally its own crypto platform from an infrastructure point of view and hired Fireblocks. Robinhood's core competency is the user interface, the convenience, ease of use, and so forth. So it could become either the digital wallet, more likely it will become a part of a digital wallet ecosystem, either alone, standalone, or in partnership with someone, or as part of someone else.
Tesla, obviously a big part of the flagship fund.
Yeah, let's hear about Tesla. So Robinhood, Robinhood has so many issues. Let's not forget, why was Robinhood ever popular? One reason only: commission-free trades. Over the past several years, everybody's commission-free pretty much now at this point in time, including brokerages that people prefer much over Robinhood, that are seen as much more secure, much just better in general, to be honest, than something like a Robinhood. So, it's not. I don't want to speak too much down on the stock because it's like $10 stock here today, so it is relatively cheap. But at the same time, it's just like, man, is that really like the best opportunity for your money? And the whole digital wallet thing, I'm like, come on, man, that sounds a little crazy. Like,
must be concerned, Cathie, that Twitter and the takeover of Twitter to buy Elon Musk is a major distraction.
Think about it like this. No one, think about it like this. This is important. I'll leave it like this with Robinhood. No one says, gosh, I'm with Fidelity, I'm with TD Ameritrade, I'm going to switch to Robinhood. Who says that? No one says that. But there's plenty of people that are on Robinhood, and then if their accounts grow over time, they're like, okay, I think I'm going to switch from here and go to another platform here or there because I feel more secure. Maybe I'll go with JP Morgan, maybe I'll go with TD Ameritrade, maybe I'll go with Fidelity, different ones out there. So that's kind of powerful, right? Just think about it like that. Am I going to switch to Robinhood? No. Like if I had to switch brokerages, Robinhood's not even in the top 10 that I would switch to. Not even in the top 10. So keep that in mind.
From the operations of Tesla.
Elon Musk is our Renaissance man, or our Thomas Edison, perhaps. And if you go back and look at how many projects these innovators were working on, you'd be astonished. How did they do that? There are such people out there. Elon surrounds himself with great business people and engineers who want to work for him. He is solving the most challenging problems of the day, and they want to be a part of that under his leadership. And,
True.
Remember, he started in the payments industry.
It's true. I mean, in terms of what you just said about Elon, in terms of people wanting to, Tesla is one of the best workforces you'll ever find, one of the most talented ones, right? And I'm sure the same could be said for SpaceX. So there's no doubt Elon Musk is a master at sales. And sales is everything in business, and that doesn't just mean selling products to your customers. And obviously he's amazing at generating hype around Tesla and all those sorts of things, right? But he's amazing at getting very talented people to want to work for him versus work somewhere else. So he's tremendous at that. It's one of his biggest strengths. Like, that man can sell. I could always tell people that kid, he's probably the best salesman on the planet. He can sell investors on why he's going to build this and do this. I mean, he's the salesman of our generation. You can call it whatever you want to call it. He's the salesman of this generation, no doubt about it. And I don't even think there's a number two. The number two's got to be so far away from him. He's number one at sales in the world.
We could actually see Twitter, and now we just started a public-private crossover fund. Twitter is in that fund because we do believe that Twitter, Elon certainly believes in vertical integration. He has the payments experience. He and Jack Dorsey seem to get along very well, and we're talking quite a bit, as we learned from the documents that came out over the court cases. And so I think even Twitter could make a run at digital wallet, not just for financial services, but for commerce.
So everybody's going to have a digital wallet. Come on, man. Like what are we talking about here? That's a Apple obviously has a huge say in that. PayPal does. I mean, everybody could say, oh, we're going to be the digital wallet of the future. Like, I just feel like that's such a generic term to throw out there. It's ridiculous.
One. And then you'll remember, I don't know if you remember, but do you remember Vine?
Yes.
My son, I thought he was going to make movies because he was on Vine constantly. That was a precursor to TikTok. And so there's some DNA within Twitter still, I believe, that could introduce something like that. You never know. And then one of my first experiences as an equity analyst was in newspapers. And believe it or not, they were the rising stars of that day. And this subscription advertising model is a very smart move if he goes in that direction. The verification, that little check, is very important to people and could help clean up the platform considerably. So
$8 for the blue tick is fair. To be clear, so you say public and private fund invested in Twitter. So you were putting in money as part of this deal?
Part of this deal, and what we're trying to do is, and I know this is an overused word, but democratize venture capital. What is the question our clients ask more often than any other? Why is it that we don't get a shot, given how innovation focused we are? This is the client speaking. A shot at some of these moonshots in the private space. And the answer is, you're not accredited. That's what the SEC says. Accredited means you have to meet certain income and asset thresholds. I think that's un-American, frankly, because if accreditation, just like with a driving license, if accreditation was about knowledge, our clients would be the accredited investors. So we said, okay, we will, using an interval fund structure, for a minimum of $500, you can participate in this public-private fund. Inflows every day, outflows once a quarter, up to 5% of net asset value. So we're fledgling. We've just started.
So how much has been invested in Twitter then, via that fund?
So I don't know what the final number was. I think it was around $1 million. Again, we're very, very small now. We're very small.
Right.
But over time, we would like Twitter to be a larger holding.
Okay, interesting. But I do really want to push you on this because he's the head of SpaceX, Tesla, the Boring Company, Twitter. There's got to be some impact in terms of the attention on the core, one of the core holdings in your flagship fund.
Portfolio, yes. So if you look at the electric vehicle part of the business, it is on automatic pilot. They have got the manufacturing team in place.
100%.
Elon says that Tesla is a manufacturer of factories. And of course, with Optimus, the humanoid robot, and all of the other automation that he's bringing into the ecosystem, I do think it's more, these are manufacturing-oriented decision makers, and he's in there if there's any artificial intelligence, especially with the robot side of the business. Where we need him.
Nowadays, Elon's not really needed at Tesla anymore. Like if he just didn't do anything with the company, they would be just fine. It's a well-oiled machine, for lack of a better term. Nowadays, the baby's just in a great spot for honestly the next decade. So I like that he's still leading the company, but it's not. 5 years ago, very different situation. Tesla needed Elon in the worst way. 10 years ago, same exact situation. And nowadays, it's just the whole product roadmap's all set up. The financials are all set up now. The whole company's set up, the management team, all the way throughout the entire workforce. It's all put in place now at this point in time.
Focus is autonomous. We think he is very diligently. He believes that he will have an autonomous taxi network perhaps next year. We believe it'll be in 2024.
We've been hearing that for a lot of years. As a Tesla shareholder myself, been hearing that for, I think his first prediction was they were going to have it in 2020, and then it was, eventually it will happen. I'm convinced of that. But we've been hearing it for a while about, we're going to have the robotaxi network. And it's like, hey, when's it coming again? What year?
The heavy lifting even there has been done. The kinds of breakthroughs we've seen in artificial intelligence over the last just even 6 months, breakthroughs that we didn't expect for 10 years have happened in 6 months. And I think it's making autonomous driving that much more possible. Again, the people who want a very hard project in the AI space are working at Tesla. This is the hardest project out there right now. And I think they have the best and the brightest.
Before I let you go, Bitcoin. It's been bouncing around 19,000 to 22,000 since August. What is going on with Bitcoin? Relatively unvolatile asset at this period.
Compared to our other assets, right? It does appear that institutions are moving in. They're taking this price decline from nearly 70,000 to roughly 20,000 as an opportunity to move into a new asset class. And, in 2018, Cambridge Associates, which is a consultant for the institutional space, basically said to its clients, okay, you may not like this thing called Bitcoin. It may sound like a Ponzi scheme to you, but it's acting like a new asset class. And that got their antenna up because what institutional investment managers cannot miss is a new asset class that will diversify the portfolio, meaning lower the correlation of the returns. And Bitcoin is doing that. And we think other crypto assets.
And your team's holding on to the $1 million forecast?
Oh, yes, more than $1 million.
Above $1 million?
Yes.
By 2030?
2030. And in order to see the building blocks, you'll see we're not making crazy assumptions. The building blocks are in Big Ideas 2022 at arc-invest.com.
So
I know you don't need to be...
Cathie Wood obviously is amazing at kind of spinning some of those questions and avoiding some of those parts. I'll say that. So interesting interview nonetheless. I felt like we didn't get a ton out of that one in terms of things that she said differently than some of the past interviews over the past few months. And I thought he started out good with some of those questions, but she's just very much a pro at kind of switching those and reversing and turning around. And at the end of the day, it comes back to her stocks, her portfolio. And do we necessarily believe in that, right? And obviously it's a really bad look, like how massively the underperformance has been over the past 5 years for the ARK fund. And it's one thing if everybody had belief in the stocks, but when you have a portfolio and your number one stock is Zoom and your number 3 biggest stock is Roku, right? And your number 4 and 5 stocks people don't even know about. And your number 6 stock is one that's been absolutely wrecked. And your number 7 stock is one that's down 80% or some insane amount, right? And you start to go through these and you're like, are this really innovation and Robinhood and Coinbase and some of these stocks? It's like, that's the issue. That's the issue when it comes to Cathie Wood. It's a massive underperformance over the past 5 years. And people looking at those stocks and being like, is this what we're supposed to be excited about? Is this really the future? Because it feels like if I know certainly if I went through and I added 25 stocks to a portfolio, I would add a lot more innovative companies than this. And, she sells out of a stock like a Palantir, for instance, over the past year. I think it was 6 months ago or so. She dumped her Palantir shares, and it's like, what are you doing there, Cathie Wood? Like, come on, man. So, and I'm sure a lot of you guys could put together probably more impressive 25 stocks than those 25. So that's just my 2 cents on that. But yeah, we'll see how things transpire over time. I'm sure her stocks could potentially, and the ARK fund could potentially bottom before the actual market bottoms. And it's just kind of tick on when that essentially happens. So appreciate everybody for joining me as always. Kind of a beast video here. Just wanted to react to that one. 18,200 plus subscribers at this point in time. Appreciate y'all. Much love as always, and have a great day.